Good morning and welcome to this Wednesday, July 20th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, had a big day yesterday. Futures, down slightly at last check. Let me give you a quick update on those. And actually, if you go into stock charts and use the symbol summary, if you're not familiar with it, you can get real-time morning quotes, pre-market quotes. Right now, the diamonds are down 26 cents, which is about 0.08 of a percent lower. So we are looking at just slightly lower Dow futures. The Spider currently down 0.09%, down 34 cents. And the Qs, which track the NASDAQ 100, down 0.03%. So relatively flat this morning after a huge day to the upside yesterday, where we saw all of our major indices back up above 50-day moving averages. That was really short-term, the next hurdle that we had, trying to get through some price resistance over the last month and trying to get through that 50-day moving average. And we did it yesterday with gusto. We did it with 11 sectors, all 11 sectors higher, 10 of the 11 gaining at least 1%. So it was a very broad-based rally as we broke through that key moving average. So it's hard to really read too much negative into the action yesterday, and really the action over the course of the last month or so, as we've continued to print some higher lows and now breaking out to, at least in the short term, a higher high. I would be, I'd continue to remain very bullish the market. My stance changed about a month ago, and I don't see anything at this point, to sway, back toward the bearish side. I'm just not seeing any really bad signals on this move to the upside. So I think, at least at this point, I think we're in pretty good shape. Tell you what, let's go ahead and head over to EarningsBeats for a minute. All right. So for those of you who are new to EarningsBeats, thank you for stopping by. If you want to learn more about us and what we do, go over to EarningsBeats.com. You can scroll down. We got a free newsletter, the EarningsBeats Digest. Simply type in your name, email address, hit that subscribe button. We'll get you started Monday, Wednesdays, and Fridays, 3 days a week. It comes out, just a couple paragraphs in a chart. Try to make it very educational. Some of the things that we look at here at EarningsBeats, I think you'll find it instructional for sure. Moving on to yesterday's action. So on Tuesday, we saw the Dow Jones Industrial Average finish up 754 points. S&P 500 up about 106. NASDAQ up 353. Mid caps up 76. Small caps up 40. On a percentage basis, NASDAQ, mid caps, small caps, all up over 3%. Small caps up over 3.5%, well, up 3.5%. S&P 2 3/4, the Dow almost 2.5. Look at these AD lines, every one of them breaking to new highs. This is really good action in the market. Again, from a sector perspective, all 11 sectors were higher yesterday. 10 of them were up at least 1%. I think utilities was the only laggard there in terms of not at least reaching a 1% gain. Industrials, the leader, up 3.57%. Communication services, 3.56%. Energy up over 3%. Discretionary over 3%. Materials over 3%. Huge day for the market. Not all of these sectors have moved back up above the 50-day moving average, though. We do have a little bit of work to do on the industrials. We finished yesterday at 89.40. That 50-day moving average is 90.07, but still AD line new high. Communication services still been in this downtrend, managed to close at 57.09, which did clear its 50-day moving average, The AD line's starting to turn up. The group is at least looking better. Still, I would say it's one of the worst relative performers among the sectors, but I do think things are improving there. Energy, we got back up and we're testing the 20-day from underneath, actually closed just fractionally above it. This doesn't surprise me. I don't know that we have a whole lot more in us. Maybe we'll go sideways. Maybe we'll turn into some kind of sideways consolidation, but I do believe energy is going to take a back seat to the S&P 500 over the summer and certainly into year end. So personally, I'm not really interested in energy shares at this point. Discretionary stocks, I like this break back up above the recent highs, breaking out above the 50-day. AD line starting to turn up. I think this one maybe looks just slightly better than communication services. Both are improving though. That much to me is clear. Materials, kind of like energy. You can see here we were at a multi-month low, coming up off of that, testing the 20-day moving average from underneath. I don't know. I'd be a little more careful, I think, with materials. 10-year Treasury yield, let's get an update here. Currently 2.96%, which is down 5 basis points. The storyline here is probably, this doesn't really move. The 10-year Treasury yield really doesn't move based on the Fed. I think a lot of folks look at it and think it's supposed to do what the Fed says. So if the Fed says, hey, we're hiking 75 basis points, you think this is going to go up 75 basis points. That's not the way the 10-year Treasury yield works. First of all, the Fed, when they raise, it's a short-term rate. It's the Fed funds rate. So you're going to see short-term rates react pretty positively and positively correlated to what the Fed does. The longer-term rates, not so much. There's a lot of other factors that come into play. I mean, the 10-year Treasury yield really kind of reflects more of what's going on in the mortgage market. Investors in the short-term bonds are completely different than investors in the long-term. The long-term, you're going to certainly take inflation into account. And that's one of the reasons I've been talking about this being so important. Why is the 10-year Treasury yield coming down? If you're worried about inflation and you think inflation's going to continue to surge higher, your expectation of yields is going to go way up. You're going to want to make a lot more on your bond investment. You're not going to accept a 2.96% yield if inflation is running at 6, 7, 8% or whatever, as we keep moving higher. So it's noteworthy when you see the yields start coming down, because the bond market is sending us a signal, just like it was sending us a signal on the way up. Hey, we needed to worry about inflation. Inflation was surging. Seems like mid-June was kind of the time when things started to change in the market. And I believe the bond market now is telling us that inflation has peaked. It's no longer going to be a problem. And I look for the Treasury yields to come down, the long end of the yield curve to come down. And if I'm right about that, and these rates start to drop, that's going to bode very well for growth stocks, aggressive areas of the market. And that's what I was looking for in the fourth quarter. It may already be starting. Second half of the year, I thought would be much better than the first half. And I think that is turning out to be the case, at least so far. We'll see whether or not that continues. But watch that yield, because as the yield drops, I think that's just sending more and more fuel over to the equity market. All right, let's move on to the S&P 500 here. And this was kind of what I wanted to see. We had the bottom, the double bottom in here at 3,900. We had gap resistance at 3,900. We came up and just barely cleared it, went back down, came back up, tested it, went back down. Look at this slightly lower low than this prior low. That to me is like a little signal, because that's how market makers can accumulate. It looked like we were rolling over and we were taking out these prior lows. That's where a lot of stops are. So once you make that break, that short-term break of support, most technical traders won't buy. I won't buy. If we're breaking down, I'm not buying, not until I see the recovery. So who buys at the bottom? market makers. They're accumulating shares for institutional clients. So when you get these reversals, that's normally a pretty good sign when you take out prior lows and then reverse off of them. I thought on Monday when we gapped up and then we sold off in the afternoon, I thought maybe we were in trouble. Yesterday, we gapped up and just went right through that high like it wasn't even there. Went through the prior two highs, at least on a closing basis, and cleared the 50-day moving average. There was a lot of good technical behavior in yesterday's market action. Now, does that mean, we can't possibly go lower? No, of course not. It's baby steps. When you're coming out of a cyclical bear market, there are so many different levels to clear. And there will be a lot of folks that are perma bears that are going to think each one of these levels are not going to be cleared. And when we fail at a certain level, they're going to think, okay, that's it. And they're going to try to get more aggressive to the downside, but I don't think it's going back down. So, and what I'm referring to, like here, let's annotate this. Now, I think, actually, let's add some bars here. All right, now let's annotate it. So I think what could happen, and this is just, could happen. I think we could see something, just maybe a slightly higher high. So maybe what we would see is current move, working our way up here to this neckline. This is, we're coming down. So potentially we could see maybe this as a left shoulder. So right in here. Then you can kind of come back up, establish some sort of a neckline. Right there. Possibly we come down one more time. August and September tends to be the worst period of the year. So if we are going to move down, it kind of would make sense that maybe we do so in August. Maybe it's a little bit later, but I'm going to say something like, I don't know, that. And what that would do is establish a possible right shoulder. This is just one possible pattern. You don't have to have a bottoming, reversing head and shoulder pattern. But what I'm seeing is this move down could be a left shoulder, neckline, head, go back up, put in the right side of the neckline. Upsloping would be better, just because it means that you've taken out this prior high once. Just starts to give it a little bit more of a lean toward the upside. And then from that potential right shoulder, that's where we could head into a very strong fourth quarter. And we get the breakout through the neckline. That's just one possible pattern. Again, I'm not sure it's going to happen. We might turn around and go right back down, put in a new low. There's no guarantees. Let's watch what happens in terms of rotation. Let's watch to see where our leadership is coming from. That's going to tell us a lot. All right. So anyway, that's what I'm looking at. I don't know, may set up that way, may not. The other indices I wanted to show you, let's take a look at the mid cap. This is the S&P 400 mid cap index. Also taking out, you can see that low right there, just below 2350, maybe 2340 or so. Went down, cleared that, came back up, really struggled, couldn't get a close back up above 2340, 2350 until yesterday. Nice move back up, barely cleared the 50-day moving average, but we did clear it. We'll see if we get follow through today. I really liked closing on that high. We'll see, again, whether or not that helps to lift us another day. Here's the small cap index. Again, you can see all the patterns very similar. Here was the low down here at around 1140, 1145. This one came up a little bit above that area, came back down, then 1145, 1150. Again, false breakdown to the downside. And now, boom, nice rally and a close back up through the 50-day moving average. We've done it before. Here we closed above the 50-day moving average a couple times. Here we did it. Here we did it for a couple of weeks. So it's not like we haven't done that. So you could look at this. I get where the bears are coming from. When you're just looking at this chart and not paying attention to anything else, you could say, well, yeah, it's done that before. It's still in this downtrend. I mean, I could draw a downtrend line that pretty much shows that we're still in a downtrend. So if I just kind of take the highs here, I don't know if it'll do it exactly, but pretty close. Connect those lows right there, and just kind of drag this down. I mean, it's something like that would be the channel. So I think it's pretty clear. You could say we're still in a down channel. We could do this across all the major indices, really. Nothing's changed. Well, one thing has changed, and it's kind of a big thing. And that is that as we have gone lower and set that new low in June, money rotated. And our aggressive areas were no longer leading to the downside on a relative basis. As we set new price lows, our relative lows on some of those key intermarket relationships turned higher while the market went lower. That's a really important signal. Again, it's not a guarantee, but why would it happen? Why would money rotate into consumer discretionary as you're setting a new low versus consumer staples? Why would money rotate toward the NASDAQ instead of the S&P 500 when we set new lows? Why would money rotate from value stocks to growth stocks when we set a new low? All those things are important because it's telling us that Wall Street is repositioning, just like they did at the top when they went into defensive groups to lead the market higher. Now they're going into aggressive groups as the market goes lower. That's why I think this is different now. This isn't like this or this or this, because it's coming on the heels of money having already rotated into growth and more aggressive areas. So to me, the breakout above the 50-day is confirmation of what we saw in mid-June. This was just a counter trend rally. There was nothing, there was no commitment by Wall Street prior to these moves to the upside. There was nothing saying, hey, this could have been the bottom, or this could have been the bottom, or this could have been the bottom. We weren't getting any signals. So I never trusted these rallies. I trust this one. Again, doesn't mean it's going to stick, but I trust it. I'm going to trade on the long side. I'm going to ignore shorting. If I get nervous, now it's a really the difference between being long and maybe building some cash. Before, it was more being in cash or maybe shorting. So it's just my strategy has changed based on the signals. All right, looking at some industry groups, I thought we'd go through technology and maybe consumer discretionary today, and maybe try to go through them quickly. Maybe we can get through communication services as well. But I just wanted to see what's working, what's not working. Well, computer services index has turned lower quite a bit in the last 3-4 weeks. One stock that's in there that I owned for a while and has really struggled, and this is part of the reason why, is Zoom. Zoom has struggled, but it's part of this group, and you can see money has rotated out of the group. So I don't know that Zoom is necessarily a problem. I think it's the group that's more of a problem, and Zoom just happens to be in it. Semiconductors, nice rally here. We need to get through the 20. We've seen these, we saw back in 2021 when inflation was the problem. We had a lot of issues, but then once we were able to get that V bottom and move back up above the 20, that seemed to right the ship. And that's what we're heading for right now. The question is, can we get through it? I don't know. Some of that move up in semiconductors could be option related from last week too. There were a ton of in the money puts. And some are like, well, why does that carry over into this week if options expired last Friday? Well, all of those in the money puts, what if traders exercise? Some of them will exercise. Instead of taking their profits on Friday, you exercise and you short. Well, if you do that, market makers are on the other side of that trade. They're long. That's why it can still carry over into the following week, because now it behooves market makers on the long side to drive those prices higher. Software is actually pulled back a little bit on a relative basis. I definitely want to see this hold this low from May. I do not want to see that. And I don't think we will go back down below that. I believe we're going to see software turn back to the upside. Electronic equipment still continues to be under a lot of pressure, not really seeing anything there. Computer hardware, believe it or not, just last week, we saw a move up to an all-time relative high on computer hardware relative to the S&P 500. Now, you might say, well, Apple's nowhere near its all-time high. I'm not talking about absolute all-time high. I mean, you can see computer hardware is nowhere near on an absolute basis near its prior high. I'm saying on a relative high. Apple has been actually outperforming the S&P 500 recently. I don't know if that one's an all-time high, but it's probably pretty close. Anyway, computer hardware looks strong to me. Electrical components and equipment turning up. It looks like the low is in from back in April. Still got some work to do, though. We're still just slightly above the 20. The 20 is below the 50. That weekly relative PPO is still below zero. Like to see that positive. Telecommunication equipment, not really seeing anything here, continues to trend lower. And renewable energy. You know, when I look at renewable energy, one problem looking at the renewable energy index is it seems to be very closely tied to First Solar, FSLR, not all of the renewable energy stocks. And so we can look at this, but I mean, again, I think if you go back and you look at a First Solar chart, you're going to see that the index looks a lot like First Solar. So I don't know what the weighting is in that index, but I don't think it accounts for some of the other renewable energy stocks that have been showing much better relative strength, like Enphase Energy, Solar Edge, SEDG, Enphase is ENPH, Jinko Solar. That one's been a little weaker of late, but overall pretty good in recent weeks and months. That's JKS. These are stocks I think that are doing much better than what this would reflect. So just keep that in mind. I do think that First Solar is well, let me just put First Solar up here versus the S&P. And we'll just see if the chart looks somewhat similar on relative basis. I mean, pretty close. Up, big down, up, down, sideways. Up, down, sideways. So that one I think we got to be a little careful of, because I don't think it's very representative of all the renewable energy out there. All right, let's go and take a look at consumer discretionary, go through a few of these names. So we got hotels. Been trending higher if you go off these lows, but the last couple of months it's been coming back down. I would say it's okay. Really want to see it get back up above those moving averages. Toys, been strengthening on a relative basis, but coming off tremendous relative weakness. Restaurants are improving. If you haven't noticed, lots of relative strength here over the last 3 months. I mean, we got a big recession coming up, right? That's what everybody's saying. Why would restaurants be going up? Well, partly because, number one, I think we're already in the recession. I like it when I see these firms saying, yeah, I think there's a good chance we could have a recession in 2023. It's like, what market are you watching? Consumer sentiment's been dropping for over a year, which is a pretty good signal of a possible recession. We've had the Fed incredibly hawkish. That many times will lead to a recession. I don't know. I don't get it. Anyway, market looks ahead. So right now, the stock market's looking at what's going to happen at the end of the year. And so Wall Street's buying restaurants. I know it doesn't make sense in the current environment, because you're thinking, oh my gosh, the economy's getting weaker. Stock market doesn't care about what the market's doing right now, what the economy is doing right now. It cares about what it's going to do in 6 months. We can see restaurants making a nice move. Specialized consumer services strengthening, looking better. Clothing and accessories still in the downtrend, but it certainly looks like the relative momentum has stopped going down as relative price action is kept going down. That to me is a positive divergence. I expect to see clothing and accessories explode back through the 20, maybe get back up to that 50. Home improvements strengthening off the low that they saw all the way back in March. Recreational services still weak. We went all the way down and tested that relative low during the pandemic. This is a very, 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 very weak group. Now, last week, I featured Carnival Corp as one of the Max Payne candidates. Carnival Corp's been up, I don't know, 15, 20% in the last 3 or 4 days. But I think it's just options related. I'd be real careful with the stock. Make sure you take your money. If you're an EarningsBeats member, based on that webinar last week, if you went into Carnival Cruise Lines, I would be taking my money. At least partial. You know, if you want to let a little bit of it ride, don't let it go back down on you. Apparel retailers, kind of like clothing and accessories, I think, been going down, set a new low, got a nice positive divergence there. I think some of the clothing retail, apparel retail, those types of stocks, I think, are going to continue to outperform in the near term. Specialty retail, really like the way this group is improving as well. Just went back up above its 20-day yesterday. Travel and tourism just starting to turn. Hopefully we'll get some more strength, relative strength out of that group. That's been a laggard throughout probably the last year or so. Gambling stocks started to take a turn up. This is a group that's been beaten down really badly. I don't know that the group will be a huge winner, but I would expect to see some relative strength after the shellacking that it's taken. Home construction starting to improve. You know, it's pretty interesting because mortgage rates have gone up to, 5.5%, 6%. Probably have come back down since 10-year treasury yield's been dropping. But I know at one point it got up into that range, and yet home building stocks have been improving. These are the things that drive a lot of people crazy when they try to figure out the stock market, because it never correlates with the news that you're hearing. It's always, again, market's always looking ahead. Broadline retail really been hit hard over the last 2 years. That was the pandemic, post-pandemic move. But it's been giving it away for 2 years. Starting to strengthen here. I actually like the group to continue to improve throughout the rest of the year. Furnishings, saw that relative bottom back in March. Really would be nice to take out that high, because there's your bounce. Here's your higher low. Another move up to clear that would be bullish. Footwear, moving down, starting to turn back up. Positive divergence. So some hope there. I think that could go along with clothing and the apparel retailers. Business training and employment agencies. This one's still been weak, turning up a little bit, but this is a group I'd be a little careful with. Durable household products, we're down below the pandemic relative lows of the March 2020 pandemic low. Not good there. Automobiles, watch automobiles. If we can get back through those moving averages, see how we were drifting, and then all of a sudden we went through these moving averages. That's what I would be waiting for potentially a big move in autos. You can see the almost similar thing here. Little sideways, we finally got through, and boom, we could see a huge 3-month rally. So, over the course of the balance maybe of 2022, if we get that breakout, I wouldn't be surprised to see autos take off, including Tesla. Recreational products been going down, but we are seeing a little bit better action. Got to get through that relative high, that reaction high right there. But if we do that, get on the other side of the 50, we could really start to see that group moving. Auto parts been downtrending. Got a little bit of work to do trying to get through that 20-day. And then we'll do quickly communication services. There is your broadcasting and entertainment, which still looks very weak. expecting it at some point to turn higher, but just hasn't yet. Media agencies just starting to turn a little higher. Big positive divergence here, lower prices. Look at that higher PPO, relative PPO. Publishers, very, very weak. You can see why the XLC communication services has been so weak. Almost every area, just awful. Internet seems to have put in that low back in May. I'd like to see a move back through the 20. I think we're going to get it. Fixed line communications actually been performing much better. But that was coming off a very, very lengthy downtrend. So maybe it's just a relative bounce. The mobile telecommunications, very similar looking chart to the fixed line. Big downtrend, maybe just a bounce. Watch that rising 20. Make sure we hold that. And then that's it. So I took you through all of those. It is 9:30. I want to just go over a couple of quick charts, then we'll wrap this thing up. Netflix reported earnings yesterday. They beat 320 versus 290. This is where we were. I'm going to go ahead and give you an update so we can get the current price. Gapped up, but we're pulling back. So we got up to 208. Now we're at 203. We're up $1.40. We still got a lot of work. I think we've got a chance to climb all the way back up near this 245, 250 area. I just think that's going to be, we're going to need some good news, probably maybe next quarter's report, some good news to get a big pop, to get things going back to the upside. JBHT, this is a trucker. They reported, you can see down 2.5% at the open today. Not very good action heading into their report, starting to show some strength. Really want to hold these moving averages on any pullbacks there. This morning, there was a big semiconductor, ASML, that reported. And stock is down. This is one on a relative basis. When I went over the Q2 earnings sneak preview last week, I did not like this stock. You can see it setting a new 52-week low relative to semis. And semis set a 52-week low relative to the S&P. So you got one of the worst performing stocks in one of the worst performing industry groups. Really shouldn't have expected a whole lot out of it. They did beat 377 versus 351, but we're not really getting a very good reaction here, down 1.3%. One last one, BIIB. This is Biogen in the biotech space. Stock down about 1 2/3%. The reason I bring this up, we had seen some relative strength in the biotechs. So I wanted to see how these biotechs perform when they report. We'll have a bunch more coming up, but at least for now, Biogen not really helping the group with its earnings report. All right, 3 you must see real quick. IBM yesterday, gap down. Talked about, I think on the show, 127.50. Actually, I think that gap is 127.60. Yesterday, we went down to 127.72. Very close. I actually bought it and then sold it at the close yesterday just to take a couple percent profit. But that was a key level. If you do own IBM, you want to make sure you hold that. We could bounce off of that candle. Let's get an update and see where we are. Nope, going back down. I still like it again. I mean, I'll buy it probably again if it gets down to 126, or excuse me, 127.60, down in that area. Anything below 128 would start to get my attention again. That's where buyers came in yesterday. So until we lose that 127.60 level, I think IBM's a buy down in that range. Let's see. Next up, I was going to show you Newmont Mining. I mean, the mining stocks earlier this year, inflation surging, a lot of fear in the market. We saw money rotating to gold, many of the miners, and Newmont had a big run. It's given it all back. We're now down near 52-week lows. 52 to 52.5 right down here is your price support. So the stock down again. It seems to me like it's on a crash course, heading for this 52 area. I'm not a big gold fan, so I wouldn't buy it even if it hits support. But as a trade, if I was going to buy it, I would wait and see if I could get this 52 level. The last one I wanted to mention is Wynn. Talked about the gamblers a little bit, trying to make a move. Wynn's trying to get through its 50. I will just say real quick that I would be watching that move. You see this volume coming in? This was a huge move off the bottom. We had a little bit of a spike in volume. We gapped up over the 20 and we failed. This was after clearing this, what used to be price support, I could put another low in right there. So this was price support coming down, low, low, bounce, and then boom, down below that level. Now we've come back up, and now I think we've got this area right around $62. We need to clear it on a closing basis. If we do, I think we could have this double bottom in place for Wynn Resorts. And I think we could be off, maybe not off to the races, but at least we could see some more improvement ahead. All right, quick update on the market. Currently, NASDAQ up 28, Dow down 51, S&P down 1. So at least we're continuing to see that money rotating into the NASDAQ, even though we got a little bifurcated market. I think that's pretty good action. Small caps, mid caps, both up fractionally. So overall, I think market looking not too bad here. All right, that is it for me. I'll be back tomorrow over at Stock Charts TV for your next recorded version of Trading Places Live. If you'd like to join me at 9 o'clock tomorrow morning, just click on this Stock Charts TV link and you'll be able to come up the show. We'll be there and you can just click to start the show. Just hit the play button. All right, that's it. Everybody have a great day. Happy trading.